Let me in this one show you the Nasdaq Composite again on a daily price chart. These are all daily bars. What I want to do here is scroll forward and show you a common problem we're going to face, which will lead to losing money, where we're going to the market is out to get us. Let's imagine this is the setup for argument's sake, and we've got the MACD coming around, it's flattened, it's going upwards, it's about to cross the signal line. Looks like a good buy signal. The stochastic is rising, the RSI is rising. If anything, the RSI has got a positive divergence because it's making a higher low whilst the price isn't. All of that's in place. The only minor thing we might worry about is that the blue line, the MACD line, is about to touch the red signal line, which often suggests it could be an inflection point where it can just easily bounce off and the price can turn. Let me just fast forward a day. This is what happens. The next day the price does indeed fall, and fall sharply. And this is a common occurrence with the MACD. When it's about that point, it falls sharply. Now, depending on where our stop loss is, we might have just got in, just the very next day got out again and thought, curses, the market is definitely out to get us. And the next day it does indeed move even further. Everything looks like doom and gloom. It goes lower. Now imagine we got out of the market. Yeah, so we're not in it anymore. The next day starts rising a little bit. MACD going flat. The day after it shoots up and we think, God, I wish I'd stayed in all along, because the day after that, and the day after that, and the day after that, and the day after that, all it seems to be doing is going upwards and upwards and upwards. What happened, and how come we got in, called it right, only to get back out, only to see it rise again? And how do we avoid that? Well, sometimes that's just simply unavoidable. You could say, well, wait a minute, wasn't this a cup and handle formation? Didn't we have a bit of a cup here, a handle where we've had a bit of a sell-off, and then this is the movement? Fine, you could argue that. You could argue, and that was shown even more so when this failed through, so we got in too early. We should have waited a bit and then gone in at the second movement, so wait for the first failure and then get in. I've tried that in the past, and to be honest, it doesn't necessarily help the trading, because sometimes what happens is you get to this point, and that's the point at which, instead of going down, the stock actually explodes upwards. So you could argue, well, okay, we still need to wait a bit more. We got in too prematurely. Having said that, given that our rule isn't wait for a break of the signal line, it's more wait for a sideways move and then a slight upward movement, how do you avoid this overall problem? Let me first of all explain what the market's trying to do. The market's trying to get you off its back. Typical of the market, what the market is trying to do is it's saying, look, I have to get as many traders off my back as possible, and that means as the stock starts moving upwards, then comes back down again, I've got to get all these people who are the weak buyers who've got in a little bit early, I've got to get them off, then I'll start moving upwards. And that is a very common occurrence, but how does that help us trade? It's not specific enough information to help us trade. One of the ways around that problem is we just wait for breakouts. For downtrends, we wait for an upward breakout, or we only wait for the even more higher probability MACD patterns, which are bearish divergences and bullish divergences. And very often that's exactly what I'll do. I'll wait for bullish and bearish divergences or breakouts from a downward trend. I'll avoid some of these. Now you might then sit back and look at one of these and say, but look at that huge trend, and look at the MACD, how it agreed to it. And if I got in at this point where it flattened out here, I would have got in at the right point. I would have got onto it. So one way around this problem is to say, okay, I'm going to have an additional rule, which is that if I need to get out quickly, I will do, like here, and it might be a false breakout, and so be it. Or I'll look for an additional pattern, such as the cup and handle. That was the cup, that was the handle, and only get in once the MACD confirms a cup and handle position. But what I'm trying to say is all of these things depend on a variety of discretionary matters. I will sometimes purely look for the cup and handle before getting into one of these. What I mean is, I really hate the fact that very often I will get this sideways move, I will get this upward move, and it turns out to be quite false, and then of course it turns out to be genuine. So I will wait for a cup and handle confirmation. I will wait until I've got a bullish divergence, etc., etc. My point is, what you saw earlier, where we were getting in at this point, and we saw the MACD going sideways, about to move upwards, etc., etc., is too textbook. It's too obvious. That's why other people get in and the market throws us off. And I wanted to point it out for that reason, and that's why we're narrowing down on a few specific types of positions, specific types of trading patterns.